Okay, good afternoon and welcome back everyone to a very special event to kick off 2025, which is how to profit from a market crash. We're entering 2025 initially as a very optimistic tone here to the overall markets, but things have shifted a bit in terms of the tone of the markets with respect to where 10-year yields are, where the equity markets currently stand, and there certainly are some rising risks of a potential market crash. Now, what I'm not doing here is to anticipate necessarily that we are going to get a market crash, but more importantly, what I want to do is make sure that viewers are prepared that if and when we do have a pullback here in the broader markets, that you are prepared for it and that you understand how you can potentially profit from that type of market condition. Now, let's go ahead and get started. But what we do here every single Thursday during our options education sessions is to help you become a confident and empowered trader, to help you grow your account sustainably in the long run. Options trading is complex in certain ways, and we want to make sure that you understand how to go about doing so in a well-rounded manner. And that doesn't mean just including option strategies, but making sure you understand how market crashes work, looking at technical analysis, fundamental analysis, even evaluating trading psychology and mindset, and how important that is to help you sustainably grow your account in the long run. So I hope that if you are new to us here at OptionsPlay, that you continue to come back every single Thursday to help you build out the tools that you need to succeed as a trader. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. We'll be going over a few things here today, but we'll start off by taking a look at just the broader equity market outlook, where we currently stand and what has shifted in terms of the tone of the overall market. I want to talk a little bit about crash statistics, what we typically tend to see around market pullbacks and crashes, and how that's going to affect your views as to how you want to go about trading a potential market crash. I want to talk a little bit about timing on bearish trades and how that's going to affect the strategies you use and how long you might consider holding on to a trade for. We'll take a look at a trading checklist and how to generate ideas specifically for a market crash. How do you identify stocks to evaluate and trade during a market crash? And then talking a little bit about position option strategies and position sizing and scaling of those specific strategies to manage those specific trades during a market crash. Now, my goal here during these sessions is to make sure that you have the mechanics of the three primary strategies to profit during a market crash, making sure that you have everything that you need to master these three strategies. So we'll start off with theory, making sure that you understand kind of the mechanics of these specific strategies and how they generate profits as the market falls, and then talking about best practices for trade entry and trade exit. So you understand exactly what parameters to specifically look for when you are deploying these strategies in your portfolio. As always, these slides are going to be available to you alongside with the recording of this webinar so that you can follow along here if you have a subscription or if you have a free trial here to OptionsPlay. That's going to give you access to the tools that I'll be showing you during today's session. It's a free 30-day trial that you can sign up for. It literally takes 10 seconds. You can do it at optionsplay.com/signup, or you can point your phone to that QR code on your screen to sign up for that free 30-day trial. That's going to give you access to everything that I'm going to be showing you during today's session with regards to how to utilize the tools to identify these bearish opportunities during a market crash. So let's take a look at kind of where we currently stand here on the equity markets. And like I said, we started off 2025 on what was a somewhat optimistic tone after, a bit of a shift towards the very end of 2024. So if you look at the S&P 500, it very much is still very much in an uptrend. However, since the end of 2025, we started to see that trend quality deteriorate a little bit. And as you can see, we've spent quite a few days below the 50-day moving average towards the end of 2024. And despite starting off back above that 50-day moving average, we find ourselves now back below that 50-day moving average. Now, that in itself is nothing to worry about, as you can see, even within just the last year. Even within the last year, we had multiple times where we had spent a bit of time below the 50-day moving average. And each time we got the pullback here, we very quickly reversed back above the 50-day moving average, and we continued in the uptrend. And this very well could be just another pullback, another consolidation that is typically healthy of a market rally, and we'll see ourselves continuing this market rally here over the next few weeks. There's nothing that necessarily suggests at the moment that things are going to go significantly south. However, I will say, with 10-year yields back above 4.6, 4.7%, that is a very different environment that we find ourselves in, with equity markets here at all-time highs and the S&P 500 trading at 22 times forward earnings. We are well above average from a valuation perspective. From a technical perspective, we certainly are call it stretch, not overbought by any measure, but with 10-year yields back above 4.6%, that adds some macroeconomic headwinds for the equity markets that we didn't exist the last couple of times we pulled back below the 50-day moving average. So things are a little different here. But if you look at the VIX here, we're trading at about 17, 18% here right now. That isn't particularly overly fearful here. This is the equity market saying that, yes, we are in a bit of a pullback here. Yes, we have consolidated, but, from a volatility perspective, there isn't a lot of concern going out, at least over the next 30 days. That could change very easily, as you have seen, if you look at the VIX here, when we were trading in the 14, 15 range and then spiking up into the 30, 40% range in a very short amount of time. That can very much happen here in the VIX here as well. So the environment that we find ourselves in are a little different. And I think that this is the type of environment where it makes sense for traders to be prepared if and when we do get the next kind of correction here in the overall market, whether that correction is a typical 10 to 15% correction or a more serious one, greater than 20%, or you get one of those 2008, 1999 type crashes where you're looking at 50+% crash here in the overall market. Regardless of kind of what of those scenarios we play out, I want to make sure that you guys have the playbook to deal with those types of situations and potentially profit in those type of market conditions. So let's talk a little bit about market crash statistics. When we refer to a bear market, that's really referring to whenever you get a decline in the equity markets greater than 20% from the peak. Usually this is correlated with high market volatility. So we usually see a spike in terms of VIX when that happens. And if you just generally look at the S&P 500, since we've made that high here in November, it certainly has the classic kind of head and shoulders pattern. We haven't broken the neckline here, and that's a really important thing. A lot of people will call this a head and shoulders pattern, but in reality, it's not a head and shoulders pattern until it actually breaks that neckline. So the fact that we haven't broken that neckline means that we are potentially seeing a head and shoulders pattern, and but until it actually gets established, meaning until it actually breaks that neckline, we can't call this a topping formation just yet. It's simply just the equity market's trading sideways at the moment. But if we do break that neckline below 580 on SPY, we're not too far away from it. That's really where things could potentially get ugly. I don't necessarily think that we have the makings of a big crash here at the beginning of 2025, but things can change very quickly, and we want to make sure we're prepared for it. The other statistic that I think is really important for traders to understand is that 60% of the time markets move higher, only about 40% of the time in the long run do markets move lower, which means that statistically speaking, taking a bearish trade, you have a disadvantage because there are fewer days where the market moves lower than when they do move higher. The one difference here for bearish or market crashes is that markets tend to sell off much faster than they rise. You know, we usually say we take the elevator down and we take the escalator back up in terms of market crashes. So crashes tend to be very violent. They tend to happen very quickly, which means that you have to be ready for it very quickly. And that's part of why we want to do this preparation now. We want to make sure you're prepared for it and you're not trying to scramble to figure out how do you find bearish ideas, how do you structure trades in a bear market, if and when that happens. You want to do that work now before it happens so that if and when that happens, you are prepared and you're ready to pull the trigger. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so let's think a little bit about timing of a bearish trade, because just because the markets are perhaps entering a bear market, maybe the S&P 500 breaks that 580 support level and starts to trade lower, you know, you want to think about timing, because again, only 40% of the time do markets move lower. You want to be very sensitive to how long you stay in that trade, and you want to try to be as optimal as possible in your timing of any types of bearish trades, a little bit more sensitive than if you're taking a bullish trade. So risk to reward on bearish trades favors when you wait for a rally before you enter a bearish position. What do I mean by that is, you know, yes, you can enter a bearish trade after the stock has started to break below some support levels, but from a risk to reward perspective, that's not as favorable, because what you can potentially make to the downside versus how much you'd have to risk if the stock starts to rally from there is not as optimal as if you were to wait for a bit of a rally here and then you entered a bearish position, because at that point your downside potential is much larger and the amount that you would have to risk if the stock were to rally is much smaller. And you want to make sure that the risk reward is as favorable as possible whenever you take a bearish trade, because the statistics work against you on bearish trades. Technical indicators can be utilized to determine when something is overbought or into a rally in order to sell. So as you can see, if you look at Uber Technologies, we broke below that $70 support level. We come back to retest that level as resistance. That's kind of your optimal time to potentially enter. So whether you're looking at this from a technical perspective, where you have an oscillator that provides overbought conditions, those are good opportunities to time that bearish trade, or when prior support turns into new resistance. And that's a good example of this, where the prior support here around $70 was broken and now it's turned into new resistance. So whenever you can incorporate as many of these techniques as possible, the better the opportunity will be on a bearish trade. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about, kind of at a high level, when we talk about option strategies during these types of volatile market crashes. First of all, selling options has an advantage during high volatility environments. Now, selling options is not typically associated with kind of bearish markets here, but we'll talk a little bit about the different option strategies that you can take and how you can potentially sell options or take advantage of that volatility when you're trading an option strategy during these types of volatile times. Short dated options will reduce the time horizon of the trades and the risk. Remember, we talked about the fact that market crashes tend to happen very quickly, so we tend to compress the time horizon of these types of trades. So we generally will trade shorter dated options on bearish strategies than we do on bullish strategies, and specifically during market crashes, because these things tend to happen over a very short period of time. They tend to be very violent, and what we want to do is we want to, number one, reduce the amount of risk that we take, and also be able to have as much leverage as possible. So shorter dated options allow us to do that. Many times we'll find ourselves trading spreads, because what that's going to do is going to help, number one, offset some of the cost of the overall trade, but also offset the total risk that we take on the trade. Whenever we're trading any type of strategy, we always want to try to risk less to make more. And the only way to do that is to sometimes trade option spreads or more complex strategies that give you that added edge. And then lastly, think about scaling in and out of trades instead of taking an all or none position. So if you think something is about to turn south, start entering a small trade. And when things start to turn south, you can start adding to that trade. And same thing, as you kind of think that the markets are bottomed here, instead of necessarily exiting your trade all at once, think about scaling out of that trade here as well. Okay, so those are some of the things that you should be thinking about at a high level when you're thinking about how should you deploy option strategies during these types of market environments. So let's talk a little bit about how to find opportunities during a bear market. Now, like I said, right now we're not in a bear market. Right now, the markets have not crashed. But if and when that does happen, you want to be able to find these types of opportunities that we're referring to. So how do you look for stocks that have recently rallied in that kind of bearish trend that gives you a better risk to reward ratio? Well, that's kind of where the trade ideas that we offer here at OptionsPlay can help you do that. And we specifically even have trade ideas that are categorized specifically for bear markets. So whenever you go to the trade ideas, whenever you go to the trade ideas section here within OptionsPlay, which is on the upper left-hand corner of your screen, you see on a drop-down menu where you have technical ideas. And those are the bullish and bearish ideas that you can find. And you can go to the filters and specifically look for specific types of bearish trade ideas. And I tend to find that in a bear market, bearish trend following ideas are the ones that are going to be the best suited for this type of market environment. And what that basically does is it look for stocks that are in a bearish trend, but have recently rallied back up to a resistance level. Things are somewhat overbought here, and the risk to reward is favorable for adding a bearish trade. And the reason for this is because if we look at OIH, which is trading around $280, if you wait for this specific rally to enter that bearish trade, if you look at the downside potential, right, from 280 down to, let's say, even conservatively 255, you're talking about $25 of potential downside in even a very conservative downside target. I think if you really think markets are going to see a bit of a crash here, your downside targets are going to be substantially more aggressive than that. But even in this very conservative approach, how far does the stock conversely need to move higher before you would say, you know what, this bearish trade didn't work out, let me get out at a loss, right? I would say that, that line that I've drew here is around 285. So if this stock got back, or this ETF got back above 290, I would say, you know what, this bearish trade where I thought it was going to hold that resistance level isn't holding, let me get out at a loss. You're risking $10 to potentially make $25. That risk reward is quite favorable. And what you can do to scan specifically for those types of ideas is to use the OptionsPlay tool. And what I want to show you here are the different tools that you can find within OptionsPlay to do so. So under the ideas, under technical ideas, first of all, you can say, only show me bearish ideas. And then more importantly, you can use the filter to only look for trend following bearish ideas. And what that's going to specifically look for are stocks like this. And let me also filter out some of the less liquid symbols, just so that we're looking at a list of stocks that are very liquid. And that's kind of how I found OIH, right? What we're looking specifically are for stocks that have a bearish trend and exhibit a recent rally that has kind of reached a recent resistance level that has now been overbought. And now we have a strong risk reward for a bearish trade. So if we look at this, let's look at a few other ideas. Let's say AbbVie, healthcare stock. this is clearly in a bearish trend, but what we want to wait for are kind of rallies back up to some kind of resistance level where the risk to reward looks far more attractive, right? Because if I look at AbbVie, which is currently trading around 177, if I think the stock is going to revisit back to, let's say, those 163 lows, that's about $15 in potential downside. And if the stock rallies back up to, let's say, 185, I would say, hey, this bearish trade is not really working out. So I'm risking in this particular case $7-8 to try to make 15. That's about a 2-to-1 risk reward ratio. How do you consistently find bearish trade ideas that look like this? Well, that's exactly what the OptionsPlay platform scans for. Under the idea section, under technical ideas, you can scan just for bearish ideas. And specifically, I like to look for trend following bearish ideas in either liquid or somewhat liquid stocks. This allows me to find stocks that I know I can trade options on that have all the technical criteria that I'm looking for to optimize a strong risk to reward on a bearish trade, given kind of the stats that we know around bear markets and kind of how to maximize your potential return. Okay, so that's all built into you in your OptionsPlay platform to scan for securities that give you the best potential opportunities in a market crash. Now, we even go one step further. We help you even identify specific option strategies on those types of stocks. And that's really kind of where under the ideas section, instead of just looking at technical ideas, we also have what we call a credit spread report. And you can filter these credit spread reports to only look at bearish credit spreads if, let's say, we're in a bear market, or you can look at bull credit spreads when things are looking a little bit more favorable for the bulls. But at the moment, if we look at kind of bearish credit spreads, one of the trades that showed up here today was on OIH, which we have a bearish trade idea on for today. So whenever I kind of find bearish trades, from a credit spread perspective that also aligns with our bearish trade ideas, that's really kind of where I can quickly find opportunities that I can trade very, very quickly using the OptionsPlay tool. So same scenario that I showed you here before. This is an ETF that recently broke below a support level around 285 after reaching all the way down to 255. It's rallied all the way back up to that prior resistance level. And that's really where I think the optimal entry now for a bearish trade is. And not only does it give you the stock, it also gives you the option strategy that you can utilize to take that bearish trade. So here it's telling me to sell the February 21st 2,800 call vertical for about $8 in credits. And we're going to dive into this specific strategy here in a few moments to show you, if you're not as familiar with the credit spread, how this strategy works in a bear market. So not only does the OptionsPlay platform identify stocks that you can trade a bearish opportunity on in a market crash, but more importantly, it can also help you structure the optimal option strategy on that specific stock for high volatility environments. So selling a credit spread is a specific strategy that allows you to harness the excess volatility during a market crash to your advantage. So not only are you trading a trade from a directional advantage, but you're also trading a trade that has an options edge. And this is all automated for you within the OptionsPlay platform. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. So perfect. Okay, I see quite a few 3s already coming in. So this is kind of the tools that we have built to help traders navigate kind of a market crash or any type of bear market, to be perfectly honest. Even if you just think market's going to recoil or retrace back the typical 10 to 15%, these are the types of strategies that you can use, and these are the tools available to you within OptionsPlay to identify the optimal setups for these types of market environments. So with that, let's start breaking down some of these specific strategies and show you how you can utilize them. What are the best practices, when you should use them, and how you should manage these specific trades. So let's start off with a credit spread. That was the example we just looked at here before. Now in OIH, the stock, the ETF rather, recently broke below 285. And what we're viewing is that, let's say we believe that the stock is going to continue trending lower from where we are. The optimal credit spread is typically going out about 45 days to expiration. So whenever you identify a bearish stock that you want to sell a credit spread on, you generally want to look out to an expiration about 45 days. That's going to maximize time decay, but minimize gamma risk. Because as you approach expiration on any short option, what happens is that gamma risk starts to explode. Meaning, if even if the stock makes a small move as you get closer and closer to expiration, that small move is going to make big swings in your P&L. So you can have a trade that's hugely profitable, and a small move in the underlying turns that profitable trade into an unprofitable trade. And you want to avoid that as much as possible. And that happens as you get closer and closer to expiration. But on the same token, as it gets closer and closer to expiration, time decay starts to work faster and faster in your favor. So you're able to harness that excess volatility at a faster rate for each day you hold on to that option. So what we're trying to find is a balance between those two things, where you have a high amount of time decay, but a low amount of gamma risk. And that happens around 45 days to about 21 days. And that's why we start our credit spreads at 45 days. We want to capture that time decay between 45 days and 21 days, so that what we do is we have an acceleration in time decay, but fewer, relatively low amounts of gamma risk. If all of that language made no sense to you, that's okay. Please, you can watch some of our videos here on our YouTube channel that actually helps you better understand option Greeks and understand the risks that you might be taking with these types of option strategies. Okay, so 45 days out is what you typically want to use for a credit spread. And then when it comes to strike prices, you generally want to sell an at-the-money call or a put, depending on whether it's a bullish or bearish credit spread. So for a bearish credit spread, we're selling an at-the-money call option. So with OIH at 280, we're basically selling the at-the-money call option, which is the $280 call option. And what we want to do is we want to buy back what's called a 25 delta call option. That's a call option that has a 25% chance that on February 21st, the expiration date, that the stock, there's a price that the stock has a 25% chance of being above on that expiration date. And that happens to be about the $300 strike price. Most platforms will give you the delta for each strike price, so you can quickly identify what is the right strike price to sell. But our platform will actually do that work for you, where it identifies the exact strikes for you whenever you want to sell a credit spread. So whether you can bring up any stock and options play, decide you want to sell a credit spread, even whether it's bullish or bearish, not only do we automate finding the 45-day expiration for you, but we'll also automate selling the at-the-money call or put, and then buying back the 25 delta call or put. And generally speaking, what you want to do is you want to collect at least 33% of the width between the two option strike prices. So 280 to 300 is a $20 wide credit spread. You want to collect 1/3 of that at a minimum, right? So that's about $6.66. Here, we're collecting $7.95, which is more than 33% of the vertical width, because whatever you potentially collect on a credit spread, the rest of that $20 is going to be your risk. So the more income you collect, the less risk you take on a trade. And the more you have a strong risk reward ratio, the more the edge is in your favor. So what we're trying to find here for you in these credit spread reports are not only stocks that technically give you an edge from a timing perspective, but the options also give you an edge from a volatility harnessing perspective. And that's exactly how we identified OIH for this specific session. And then, as you can see here, the characteristic of a credit spread is important to understand, because every single options trade is a trade-off between probability of success and risk reward. Any trade that has a high probability of success will have a low risk reward, and vice versa. Stocks that have a very strong risk reward will have a low probability of success. And a lot of people will say, well, I want both. Well, you're not going to get both. You always have to have a trade-off between one or the other. And one is not better than the other. It's not like high probability trades are better than high risk reward trades. It's just a matter of your it's a matter of your views on the underlying security and what makes sense for that specific environment. So credit spreads are a high probability of profit strategy. As you can see, the pop on this is a 62% chance of profit on this specific trade. But which means that, 6 out of 10 trades, you'll be profitable if you trade these types of strategies. Sounds great, right? But it's important to understand that what you're taking on in terms of risk is more than what you can potentially make. So here I'm making potentially $800, but I'm risking about $1,200 on the backside of that. So it's really important to understand the characteristics of a credit spread that has a negative risk reward ratio associated with the higher probability of profit. I see a lot of traders gravitate towards trades with high probability of profits, thinking that, oh, if I just find trades that have an 80, 90% probability of profit, I'll make money in the long run, forgetting the fact that the 10% of the times that they do lose money, they could be losing far more than what they're making, the other 80 to 90% of the times when they are making money. So it's important to understand that when you're thinking about whether or not to deploy these types of strategies. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Okay, perfect. So let's talk a little bit about managing credit spreads because, this is actually from a management perspective, one of the more complex strategies to manage because there are 3 potential exit rules. So once you enter a credit spread, there are 3 potential triggers that would result in you closing out this trade. The first one is a stop loss. If you lose more than 100% of the premium that you collect, it's time to get out of the trade. So here I'm selling the 280 call, buying the $300 call. Net, I'm receiving $7.95 in credits for this specific trade. That means that, if something that I've sold for $7.95 now trades at twice the amount, $15.90. Please ignore the extra digit in that number. But if something I originally sold for roughly $8 is now trading just shy of $16, that would mean that I've lost 100% of the premium that I've paid. So I've lost $7.95 on this specific trade. It's time to get out of this trade. This trade can go all the way out to $20, right? Because the distance between the two strike prices is $20. So I could potentially lose more than the total premium that I collect. And what you want to do in these types of scenarios is try to prevent that by putting in a stop loss at 100% of the premium that you received. On the flip side, if the trade starts to go in your favor, you generally want to take profits early. You want to take profits when you've reached 50% of the max gain. So if you collected $7.95, you want to start taking profits once you've made half of the potential profits. And what you're going to find is that, you're going to take profits far more often because your take profit is much closer to the current price than the stop loss orders. So that's kind of the logic behind why do you take losses at 100% but take profits at 50%. You're going to take profits far more often, and you're generally going to have a probability of profits that are actually higher than the 62% because you're taking profits before you reach that max profit. But for credit spreads, there's a third rule. If you were to reach 21 days to expiration and you have not triggered a take profit or a stop loss, you also want to exit this trade. Now, if you still believe in the bearish thesis of your specific stock and you want to continue to get bearish exposure in the stock, well, what you want to do is you just want to close out this trade and open a new 45-day credit spread. Just use the OptionsPlay platform to help you structure a brand new bearish credit spread and basically recenter the trade, based on where the current price is, and go out another 45 days. And the reason for that is because you don't want to hold the credit spread in the last 21 days. In that last 21 days, the strategy starts to get really sensitive to small moves in the underlying. So you could have a trade that's profitable today, and a small move in the underlying turns that profit into a loss very quickly overnight. And you want to avoid that. So by closing out a trade at 21 days to expiration, you're going to start avoiding that extra sensitivity that's going to start creeping in as you get closer and closer to expiration. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Okay, perfect. So let's talk about the next strategy, which is a more hedging and tactical strategy. Now, this is a strategy very similar to a credit spread, but what it does is it kind of flips the dime between probability and risk reward, and that's a debit spread. And generally speaking, a rule of thumb here with debit spreads is that you want to go a little further out in expiration for a debit spread Because whenever you're buying an option, time decay is actually working against you, right? So we were talking about the fact that when you're selling options, time decay works in your favor. You're harnessing that excess volatility. But when you're buying options, the exact opposite is happening. Time decay is working against you. So one of the best ways to offset some of that time decay is to, number one, buy a long dated option, because long dated options decay very little each day, right? It doesn't matter how much you have in terms of time premium that you're purchasing. What matters is how much time premium you're losing for every day you hold on to the trade, right? So if you're only holding on to a trade for, let's say, 3 weeks, it only matters of how much you're losing over those 3 weeks rather than how much you're paying for over the 60 days, right? So, if you were to just buy a 3-week option, you're going to lose 100% of the extrinsic value of the option, versus if you buy a 60-day option and you hold on to it for 3 weeks, you're going to lose a much smaller portion to time decay. And that's going to help you, offset, the potential P&L on the specific trade. So you go out 60 days, generally speaking, on a debit spread. And what you want to do is you want to buy typically an at-the-money call or a put, right? So in a bearish trade, we're buying a put option. But the problem with buying a put option is that you are effectively paying for exposure all the way down to zero. You're basically saying, I think theoretically this ETF can go all the way to zero, and you're paying for it. So in this particular case, the reason that we use a debit spread in this type of bearish market example is because even though we have a bearish view on OIH, we don't think the stock's going to go to zero, certainly not by March 21st, before the end of the first quarter, right? So we don't think that all oil stocks in the world are going to get wiped out and they're all going to go bankrupt by March. So why should you pay for all that downside? And that's really kind of where the debit spread allows you to buy that downside, but also sell some downside as well. And what that does is offset the cost of the trade, offset the total risk that you're taking. So instead of just outright buying the 280 put, I'm going to sell a 245 put against it. And what that's going to do is I'm going to reduce the overall risk that I take on the trade. And as you can see with the debit spread, I am risking less to make more. I'm risking about $1,200 to make $2,200. But the offset of that is that my probability of profit is now only 37%. Is one better than the other? No, it's just a matter of what your views are for this specific ETF. In a credit spread, even if the stock doesn't really move very much, you can collect 100% of the premium or, the maximum profit on a trade. But when you're trading a debit spread, the stock has to move before you can be profitable. But if it does move, as you can see, you can risk less to make more. So it really just depends on how confident you are on the size of the move and whether that move is going to happen over a shorter period, a relatively short period of time or not. If you're less confident, a credit spread might make more sense. If you are fairly confident in that bearish move, that's really where a debit spread could make a lot more sense. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about managing a debit spread, and this gets a little easier than the credit spread, because there are only 2 rules. There's a take profit and stop loss rule when it comes to a debit spread. Generally speaking, if you lose more than 50% of the premium that you pay on a debit spread, it's time to get out of the trade. So if you're paying $13.70 for that 280 put, and then you're collecting $3.20 to sell that 245 put. So notice here, let's just break this down, right? Instead of risking $1,300 just to buy that put option, I'm only risking, in this particular case, just a little over $1,000 per contract by selling that 245 put. I'm collecting $3.25. So I'm reducing my overall risk by nearly a quarter on this specific trade by using a spread versus outright using that put. So I'm paying $10.50 for this debit spread. If I lose half of what I've paid, right? So if something I paid $10.50 for is now worth half as much, $5.25, it's time to get out of the trade. When you lose 50% of the premium that you pay on a debit type structure, chances are the stock is not going to move in the direction that you expected to, certainly not in the time frame that you originally thought it was going to move in. So it's better in this particular case, instead of holding on to the hope that this stock will come back and potentially losing another $5.25, you're better off saying, okay, I'll take a smaller loss, only $5.25 versus $10.50 loss, and I'm going to take that $5.25 and apply it to the next trade rather than holding on to this trade, hoping that maybe this comes back at some point in the future and potentially losing another $5.25. Okay. On the flip side, if the trade starts to go in your favor and you have reached 75% of the premium paid, that's when you can start thinking about taking profits. So if you pay $10.50 for something that's now worth $21, 100% gain on the specific trade, it's time to also consider taking some profits on this specific trade. So the rules for managing debit spreads are quite a bit simpler. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Okay. So lastly, now this is a bit of a deep end of the pool. And this is something that most traders probably wouldn't think to take in a bear market, but this is a trade that is suitable for traders with a larger account that has a larger risk tolerance, but it is a trade that actually truly takes advantage of the elevated implied volatility that happens during kind of market corrections. And that's a short strangle, because you're not only short deltas, which gives you bearish exposure, you're also short a time exposure on 2 legs. So you're doubling kind of that exposure that you're getting with the credit spread. And a credit spread, your main component is your short an option, but you still have a long option to offset kind of some of the risks, right? So your net barely short from a time decay perspective, versus a short strangle, you're short the markets and you're short time decay on 2 separate legs. And that time decay is really kind of what you're trying to capture in addition to kind of the bearish trade. So the way that you want to structure kind of a short strangle here is you generally want to go out also about 45 days for the same reasons you go out 45 days for a credit spread. And then what you want to do is you want to adjust the strike prices so that you're selling the strangle not straddling the current market equally on both sides, but you're moving it to correct for the directional move that you believe it's going to move in. So what you want to do is you generally want to sell a 30 delta call option, so a call option that's relatively close to the current price of the stock, and then sell a 15 delta put, a put that's much further away to the downside, giving you a lot more room here to the downside. A 15 delta put refers to a price where there's about a 15% chance the stock will be below that price at that February expiration, and a 30 delta refers to a strike price that has about a 30% chance the stock will be above that price at expiration. So by skewing your strangle to the downside, what you're doing is you're getting that bearish exposure while still collecting premium on both sides of that short strangle. Now, here, as you can see, I can potentially make $887. That's how much I'm collecting on this strangle. And my max loss in this particular case is unlimited. And that scares a lot of people off. But if you look at this, the Qs are around 515 right now. By selling this 475, 535 strangle that expires on February 21st, which is about 45 days from now, look at my break-even price. My break-even price is 466 to 543. So as long as the Qs are somewhere between 466 isn't even here on this chart. It's somewhere down here, right? So this the ETF's around 515 right now. 466 gives me probably about that much downside or so, right? So as long as the stock stays within this specific range, or 543, which is up here, right? As long as the stock stays within that wide of a range, I'm going to be profitable. Only if it exceeds that range do I start losing money. And a lot of people, get really kind of nervous about the concept of unlimited losses, right? But think about this, right? The Qs represent 100 stocks. This is not the type, these are not typically the type of assets where you see, 30% crashes in a 45-day period. They tend to happen fast, but they don't happen as fast as, let's say, single stock, right? Where, a single news event like earnings or something like that, or a product miss or something like that, causes stocks to make 25% losses in a single day. That doesn't happen with ETFs, which is why these short strangle trades work very well for ETFs, index options, and trades like that, where it gives you kind of that negative downside exposure while giving you maximum short theta or short time decay and short volatility in this particular case. So when volatility is high and you want to capture time decay and you want bearish exposure, a short strangle is a strategy that is not in most traders' mindset, but is actually a very effective strategy in this type of market environment. And you'd be surprised at how far the stock would have to move in order for these types of trades to be unprofitable. So I'll model this out for you real quick, looking at the Qs. I'll model that February 25th, 535, first 535 on the call side, 475 on the put side, right? So as you can see, 535, notice how that's the 30 delta, right? That's the 0.3 next to the 535. And then the 475, how it's 0.14. That's the closest I can get to that 15 deltas. That's the 475s. So as you can see here, I'm collecting a little bit more than that, $8.96, almost $9, right? That's how much I'm collecting for this strangle. Now, how far does the Qs need to move in order for me to lose $900 in this specific trade? As you can see, I'd have to at around 450. So the Qs would have to reach 450 in order for me to just lose what I'm potentially making on this specific trade. So this would have to retrace back to the September lows in order for me to lose just the same amount that I'm collecting, right? So unlimited sounds really scary, but as you can see, look at how far the Qs would have to move for me to take on the same amount of risk that I'm potentially making on this specific trade. It would be monumental in terms of the move that the stock has to move in that 45 days in order for that to happen. Yes, it can move more, right? Theoretically, the Qs could go even below 450 and you can lose more than that. But a lot of people have the wrong perception of how far or how much they can potentially lose, and given how far the stock can potentially move. So that's one, like I said, deep end of the pool that probably isn't on your radar, but can be potentially a very effective strategy, especially when you do it on an index option or an ETF at expiration. So let's talk a little bit about strangle management. There's a few different things that you should do. Number one, you should have a risk reward similar to a credit spread. But what we typically use are slightly different thresholds. You have an exit rule, a stop loss rule and a take profit rule. A stop loss rule is usually around 50% of the premium that you collected. So in this particular case, if I collect $8.87 for the strangle, I generally want to have a stop loss at about once I lose 50% of what I'm potentially collecting here. So $8.87, if you've sold something for $8.87 and is now trading at $13.30, you've lost 50% of the premium that you originally could potentially make on this specific trade, and it's time to consider getting out of this trade. On the flip side, a strangle, if it reaches 25% of the premium received, it's time to potentially take profits. So for example, if you sold something for $8.87, that's now trading at $6.65, it's time to start taking profits on this specific trade. Now, because you're taking profits pretty quickly, right, only 25% of the max gain, chances are once you hit your profit target, you still have a bearish view on the markets, right? Maybe the markets haven't reached kind of your downside target. What you want to do is you want to take profits, but then sell a new 15-30 delta 45-day strangle at that time, right? So let's say 2 weeks go by and the stock and the strategy hits your take profit level. You have 45 days, but 2 weeks in, you've hit your take profit. What you want to do is you want to basically recenter your credit spread, your strangle, basically go out another 45 days, identify the 15 delta put, identify the 30 delta call, and sell a new strangle, and basically recenter the trade and reestablish kind of this bearish strangle. So even though you might be taking profits fairly early, you are taking profits, but you're getting right back into the trade. You're just getting back into the trade at the more optimal parameters than things as they start to shift around over time. So that's kind of this is a more complex strategy. There's some more caveats to it, but for those of you that have a little bit more experience trading and are comfortable with understanding the risk that you're taking, because if you think about the downside risk that you have with the Qs when you sell a strangle, it's the same as buying 100 shares of the stock or selling a put option, right? It's actually less risk than buying the shares, and it's less risk than selling a put option. So, this is really something that I think a lot of people have tough time getting their heads around, that unlimited loss. But when you actually compare it to the risk that you're taking when you buy the stock versus the risk that you're taking if you sold a put, it's actually less risk than both of those strategies. And that's really kind of something that it takes time to get your head around that and get comfortable with it. But for those of you that are at that stage, this is a strategy that you might want to consider in a bear market. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, we've covered a lot of things here today. Hopefully this gives you a good sense for what is available to you in terms of the tools to help you identify bearish stocks. Hopefully this gives you a clear understanding as to kind of the statistics around a bear market. That's going to help you determine what strategies that make sense to you. And then ultimately, hopefully this gives you a good sense for the different strategies that you have at your disposal to potentially take in a bear market. But I always find that, with traders here, where the audience here is pretty wide, right? Some of you have a lot of experience trading options. Some of you are brand new. One of the things that I do want to highlight here within the OptionsPlay platform is our paper trading and portfolio tracking that's available to you here at OptionsPlay that allow you to test out all of these strategies without risking your real capital. Try it out. See how it works out for you before you deploy it into your real account. It's a really powerful tool that we offer here at OptionsPlay. So for any strategy, let's say you're just exploring strangles for the first time, you're not comfortable trading this in your portfolio. Well, click on trade, and what you can do is you can select one of your paper trading portfolios. So as you can see, you can just, if you don't have one created, whenever you go here, you can just create a new personal portfolio, create one called the paper trading account, whatever you want to name it, create one for all of your live accounts as well. And what you can do is you can basically add positions to your paper trading portfolio. Say, okay, I've never traded a strangle before. Let me add this position to my paper trading portfolio. And now I can go to my portfolio tool, which is here in the upper right-hand corner. And I can view this trade, and especially as it ages, as it kind of reaches my take profits, reaches my stop loss levels, I can start looking at my paper trading portfolio and see how's that strangle performing, right? So here I've sold the February 21st 475 535 strangle. P&L on a 0 right now because I just entered it, but I come back tomorrow, as they come back the next day, you'll see that P&L move, and that's how you're going to be able to see how this trade works as if you traded this in your live account without risking a single dollar. Get comfortable with the trade. Make sure you are familiar with it. Do it a few times before you start risking your real capital. Really powerful tool. And also, if let's say you have executed this trade in your real account, right? Let's go back to that OIH example. Let's say you really did execute this credit spread. Well, we can help you track it, right? So if you have multiple portfolios across different brokerage firms, if you have a brokerage firm that doesn't do a very good job in helping you track kind of your multi-leg trades, or if you have multiple trades in a single symbol, this allows you to kind of track all of that here in one place, right? So let's say you sold this for $7.95, and you can even say, I collected $7.85 or $7.70. You can enter the premiums of what you actually got executed at. So let's say you got executed at $7.75 in your, I don't know, your Schwab account, right? So, you can create as many portfolios as you need, one for your Schwab account, one for your Tasty Trade account, one for your Interactive Brokers account. You can throw the trades that you executed at with the specific prices that you executed at in those specific portfolios. So let's say, let's say I traded this in my CNBC Pro trades. I write options ideas for CNBC every single week, and I use this to track that, right? So this allows you to go into your portfolio and say, like, here are all my TD positions, here are all my Schwab positions, here are all my Tasty Trade positions. So you can have one place consolidated to track all of your positions at once. So really powerful tool that allows you to do all of that paper trading, tracking all of your live accounts all in one place, all of your complex strategies. Really powerful tool. And as you can see is that not only can you see your unrealized P&L, you can see your probability of profit, your cost basis, but it'll also break down the specific strategies. So if we go back to that OIH trade, right, you can actually break down kind of your probability of profit on the specific trade, how much you're up or down in that specific trade by, and then you can also look at it on an individual leg basis. So if you end up needing to adjust one leg, sometimes on a calendar spread or even a strangle, you might want to adjust just one leg, you can do so, and you can actually use this tool to help you roll those specific positions. You can modify it, you can close it, you can roll it, all within the OptionsPlay platform. So I can choose to roll this position, I can choose what expiration and strike price I want to roll it to, and it'll show me my resulting position here at once. And I can just click on trade. If I did execute this trade on my brokerage firm, I can click on trade, enter the premiums, add that position, and now the portfolio is now tracking your new trade. So a lot of powerful stuff that's built into the OptionsPlay platform. So I wanted to highlight that for anyone who may not know that exists. So make sure that you create your portfolio, add the positions to your portfolio, and then you can start tracking them all in one place, whether that's a live account or a paper trading account, all in one place within your OptionsPlay platform. So with that covers what I wanted to share with you here today. Like I said, I hope that this is helpful in giving you a better understanding as to what is available here at OptionsPlay, and more importantly, showing you kind of how to navigate a bear market or a market crash. Like I said, this is not a expressing a view that I think markets are going to crash, but things have deteriorated a little bit from a macroeconomic picture perspective, and their risks are rising of a market crash. So it's better to be prepared now for it, so that if and when that happens, you know exactly what to do, how to find strategies, how to find symbols, how to find strategies, how to deploy them. Practice trade those things now so that you are ready to go if and when the market crashes. So like I said, this is all available to you here at OptionsPlay. The slides, the recordings, we'll repost that here this weekend so that you can get access to everything. The platform that I showed you here today, including the paper trading features, are all available for free for 30 days as a free trial at optionsplay.com/signup, or point your phone to that QR code to sign up. It takes literally 10 seconds to sign up, no credit cards required. Check it out, see how the platform works for you before you are committed to paying for it. We're running some sales at the moment, so really looking forward to some of you coming on board and utilizing these tools for the next market crash. But even without that, if you have a bull market, we have plenty of tools for you to generate